Hello, everybody, and welcome to Super Bowl Sunday. As we like to do every week, we like to take a look at the past week's market activity and then kind of bounce around the market and look for something to trade. Well, here's the market. I show it to you every week. Pretty much the last month, it's gone nowhere. You can see it kind of went up, came down, went up again, but essentially from a month ago, we're kind of right back where we started. Volatility ticking up a bit because on Friday, obviously, the market took a bit of a hit, but nothing spectacular. No big bumps in volatility like you see here, obviously, when the market took a huge dive. So the market's fairly stable so far. Volatility is kind of stagnant. This is the S&P 500. If we look at the NASDAQ, it looks always fairly similar. Pretty much the same story. Volatility ticking up, but nothing spectacular. The Russell is always the one that looks a little bit different. Same kind of basic thing as far as the movement, but again, we had this huge drop over here and it never quite recovered. The NASDAQ and the SPY are kind of near their all-time highs, where the Russell, which is small cap stocks, is kind of way down here, doing the same basic movement though, up and down, volatility again, very minimal. So what are we going to trade this week? Well, we're in the middle of earnings season, so there's a lot of earnings going on. We always want to trade stocks after earnings. We don't want to put on trades during earnings because those are called binary kind of events where we don't know what's going to happen from day to day. But before earnings, anything drastic could happen. So we kind of stay out of the way of earnings, and we look to trade things after earnings. So if we look at Apple, Apple has had earnings. As you can see, it was a huge move around earnings. But again, ever since then, it's kind of gone sideways. But volatility is still pretty decent. Still way up here at 33. So post-earnings, after a big move down and then bouncing around, seems to be in a range, and volatility seems to be decent. So what we're going to do is we're going to skew this slightly upwards, meaning like I look here and I go, okay, and this is all just my assumptions, right? Nobody knows anything. This is just me making an assumption. The low over the last basically 4 months has been here at around 220. So that's going to be kind of like where I think like the bottom of this could go. Of course it could go lower, but my assumption is it's going to stay around 220, or if it does break that, it'll bounce back fairly quickly. So I'm going to leave more room to the upside, which means I'm going to put the put side of my iron condor closer than my call side. You'll see in a second it's going to look more like this. So the stock's going to be tight at the bottom and a little more room to move at the top, because I think if it's going to move, that's where it has more room to move. Again, purely an assumption. So if we go to the trade page, what I'm going to do is normally we go here at 47 days because it's close to 45 as possible, but these aren't nearly as liquid as the 40 days. So if you see here, if you look at these numbers, look right here. If I go a little bit out of the money, look at how wide these are, right? It's $1.53, 410. That doesn't help me. 284, 450, right? Those are way too big. But if I look at the 40 days and I look at those same strikes, you can see they're a lot closer, right? 257, 269. They're a few pennies away, at 10 cents away, 10 cents apart. That's liquidity. We want bid and ask spread to be as close as possible. So in this case, I'm going to go to the 40-day for that reason. It's way more liquid than the weeklies. So I've already saved us the trouble and set this whole thing up as I've already explained. And what I'm doing is the stock is essentially, we'll just make it easy. Let's say it's 227. So I'm going $7 down on the put side. So on that 220 put that I showed in the chart, and I'm going further up. I'm going over $15 away on the call side. Whoops. Again, leaving more room for it to move upwards than downwards. Purely my assumption. I'm doing what they call skewing this to the upside, leaving more room to the upside than the downside. And in this case, there are $5 wide strikes. So it's a 220, 215, 245, 250 iron condor, and I want to collect at least 165 or more for this to be a valid trade. And why is that? Because, remember, I'm looking for a minimum of 33 cents per dollar width. This is $5 wide, which means the minimum amount I'm looking to collect on this trade is 165. So I got to collect at least 165 or more for this to be a valid trade, and we do. We collect 184. So, assuming everything stays here tomorrow for Apple, we're going to create this, like I said, skew to the upside iron condor where the put side is closer than the call side. And as long as we collect at least 165 or more, this is a valid trade for tomorrow in Apple. Enjoy the Super Bowl, everybody. Hello everybody, Cal here with an ancient Chinese proverb which I'm sure you have all heard before. Give a man a fish, you feed him for a day. Teach a man to fish and you feed him for a lifetime. Why am I telling you this? Because most services out there just give you a fish. They tell you, oh, make this trade, I made this much money, I made millions of dollars, do this, do this, do this. That's not my goal. My goal is to teach you to fish for a lifetime. I want to teach you the skill of trading so you can go out and make as much money as you want to on your own. And the best way I've come about to do that, at least for me, is to basically set up an alert system where you can watch me trade in real time. You'll get texts or emails directly to you in real time of the trades I make every week. I do 2 to 3 trades a week, so it's going to tell you everything you need to know about the trade, why I did it, how I did it, what I did as far as specifics. And then you're also going to get the closing alerts when I close them for the maximum profit potential on these trades. Like, how do I close these trades? Why do I close them? To get the best profit potential over time. And I want you to do it without any risk, which is why I've set this up for $1 for the first month. You'll get my option income alerts for the first month for only $1, and you can cancel anytime, so there's no risk on this one. You're risking $1 to see if you can turn that knowledge or learn to fish. You'll use this code, make B1. If you want more, we have the option Pro Alert, which is the exact same alert, but it also gives you access to every course and webinar I've ever made. It's a 13 course bundle, obviously thousands of dollars in knowledge. Again, you can do this using this code, and this is only $19 for the first month. And again, you can cancel this one at any time. So again, a risk-free attempt to learn and see if it's something you want to do. Here they are right here. If you want to go do it, you can go to sharpertrades.com, go to the products page. These two will pop up. You can type in these codes down here, or you can just go directly to this link right here and it'll build the code in itself, or the attachment I have at Udemy along with this little video. So again, my goal is to teach you to fish. I can't think of a better way to do that than to trade side by side with me in real time. Hopefully you jump on this opportunity. Hope to see you soon. Take care.